Hi there everyone, and welcome to the first edition of On Track for 2020. Can you believe it's 2020, and can you believe it's already racing away? I'm recording this on the 21st of January, so we had a little break and back on the 6th and easing into it, and here we go, here comes 2020, and what a year it looks like it's going to be. So in this, my aim as always is to give you information to put current events into context around what's happening in financial stuff. Firstly, as always, a general advice warning. That just means before you act on anything I'm going to talk about, you should speak to us. This is designed for clients of McGregor Wealth Management. If you're seeing this and you're not, feel free to enjoy the content, but do not act on this without seeking advice, and we'd be happy to talk to you around that yourself. So let's get into it. We're going to look at some economic news and some other bigger news as well. I'm going to put it into context of what's happening in the market, and as I record this, we're recording record highs, and I'm going to talk about what that means. I'm going to talk about what's happening in each of the individual markets that we invest in and put it all into perspective as usual. News highlights, wow, what a summer. Bushfires dominated the local news. As we speak now, it's only just dying down. Ironically, the tough country we live in Australia, we've had some floods and some other storms, and that's partly the nature of Australia. It's good to see that risk diminishing, but I know there's still some parts of the country where it's a challenge, and thoughts go out to anyone affected by the fires. Growth in Australia at the moment is about 1.8%. The experts are saying the impact of the bushfires is going to take about 0.5% off GDP, but it's a bit of a timing thing, because what happens in these times is there's less money spent periodically. People weren't spending money on holidays, etc. But then post all the damage, a rebuild starts. And when that rebuild happens, it puts money back into the economy. So most of that 0.5% loss will come back. And some of it may come back sooner rather than later, as insurance claims get paid out and houses get rebuilt. That's actually all a boost for the economy. So net over the course of the year, it's probably not going to impact too much, but we may see some timing differences where GDP growth looks lower, and be very careful about interpreting that. As the news media announces the economy slows due to bushfires, just remember that it will rebound and then some. So inflation's still low, hanging around that 1.6%. Unemployment steady and low. RBA cash rates are starting the year at 0.75%, and the market's in consensus that it's likely to go to half, and some people think it will go to 0.25. That's pretty much where bank rates will go. We're seeing term deposit rates, at a quick look, the ANZ 1 year term deposit rate is 1.4%. I'm sure you can chase up a little bit extra, and there's the odd special around, but it's pretty dismal and historical lows. And if the RBA does cut by another quarter or another half, we'll probably see that definitely come off term deposit rates. Aussie 10-year government bonds, 1.2%. It's going to be interesting to watch that. Sometimes when rates get cut at the short end, the long end, being 10-year government bonds, will start to go up as people start to anticipate growth eventually and higher rates eventually. So that's one we watch in particularly, and that starting to go up will be a sign that the market thinks that the economy is going to grow a bit. We're hitting new highs for Aussie shares. I'm going to talk about that in detail, because when you hear the media say share market makes record highs, the natural emotional behavioural reaction is to go, wow, it's really high, and when we think it's really high, we think it's going to fall. I'm going to go through that, what actually happens and what emotionally happens as part of this today. Internationally, we've had US and Iran tensions with the whatever word you want to use, assassination, elimination of Iran's top general, and the stuff that went on after it looks to have subsided pretty quickly. I don't think Iran really wants to pick a fight with the US. We've had the trade war agreement, and that's been the market jump. As the Iranian tension diminished and the trade war agreement was signed, that's what's driven that solid start to the year, and I'll talk more about both of those when we look at what's happened in international markets. Growth in the US, global growth stuck at around 3% for the next few years. It's a tale of two stories. You've got the developed world like China in the 6-ishes, and I'll talk about what that means to us. And US solid, but we're talking solid in the mid-2s. Long-term averages are probably closer to 3, but yeah, when you allow for inflation, it's doing reasonable. So the theme hasn't changed. We're, low to moderate economic growth, low inflation, low interest rates, which means we're firmly stuck in the wall of worry where we're getting good returns. Ironically, very good for last year, which I'll talk more about. But we expect returns to be lower. But while we're in this boring phase, we're likely to have less extreme volatility. We'll still have some volatility. So let's get stuck in, and just with a reminder, as always, the 4 foundations to a really good investment strategy. Firstly, a personal plan. All our clients, you all have plans that help us articulate a portfolio to achieve those goals. Learning from history is so important. In listening to the media commentary at the moment, in listening to even watching professionals, particularly younger professionals in their 30s and 40s, who haven't necessarily learned from history or been through some cycles, the commentary is quite interesting. And you'll see when I go through that understanding of cycles in a couple of slides what I mean about that. The behavioural traps are still the biggest enemy to retire. So that is the psychology, that is our emotions, the fact that, and I'm going to use this again, when you hear the media say share markets at record highs, you immediately go, what goes up must come down, and emotionally you start to get worried. That's normal and inevitable, and that's why it's so important that we learn from history and analyse what's actually going on, which I'm going to do for you today. And then once you've got all that covered, it's then just smart investing. That's the right asset allocation, reasonable cost investing, and being smart about it over time. Our market context is our wall of worry. So we'd say how the market goes through the 5 main stages, 3 main stages with one of them broken down. But we have a boom. We'll call that FOMO, fear of missing out, and that's where people do crazy things because they think the market's going up forever. It's inevitably followed by a bust, or the fear, which is where the market goes down. It's really just a recovery back to normal, but for those that join the party late, it can be quite brutal and savage. And then we've got most of the time the wall of worry, where we're bouncing around, and people are worried all the time. The things that drive these cycles is psychology and emotions. And if you picture that, psychology is like a pendulum, and it swings from fear to greed, to worry, to doubt, to fear, to greed. And most of the time it's little swings, but once every 15 to 25 years, it swings really hard to the greed side, and then inevitably we get the burst back. But most of the time we're just in these little cycles of wall and worry. We're not too worried about them because ironically during that time we get good steady growth, and the market, while it may drop 5%, 10% reasonably regularly, we're never worried about that. It's the 20 to 30% ones that where most people do damage and make silly decisions. So let's remind ourselves of our acronym here, that most investors mess it up, and they do. And I think it's going to be a big year for messing it up, and there's a few things around that. With the record highs, I think a lot of people are going to be overly cautious. I think with low interest rates, people are going to delve into things they shouldn't be in, and I'll talk more about that next month. But one of the biggest dangers for retirees is trying to chase higher returns to make up for lost term deposit rates, and particularly for inexperienced or unadvised clients, that's going to lead to some classic mistakes. So to mess it up, quick reminder, the M is for media. Do not let the media be your advisor. I was just talking to someone who said, they say we're going to have another GFC because of yada, yada, yada. It doesn't actually matter what the yada, yada was. I said, who was they? And it was the morning show. And I can't think of any worse place to get your information for your long-term financial planning. Because they've got to keep you watching every day, so they're going to focus on anything negative that they can. Because they know that emotionally, and that's the E in mess it up, that keeps you viewed to the media, but it's certainly not, our message around that is it's not the best way to make investment decisions, because you'll normally be exactly the wrong way around. We panic when markets are down, we get greedy when markets are going up, and we've almost got to do the exact opposite. We tend to focus on short-term issues. So right now, some of those short-term things have been the trade war, they've been the US-Iran tensions, that one keeps coming and going. We're now going to have record highs. We're going to have the US election year. We've got, this isn't a short-term focus, but at the moment it's a massive obsession, and rightly so for many reasons, but climate change, in light of the bushfires, is becoming a central theme around a lot of commentary. And we see some people assuming that these conditions are going to be the new normal, which sounds exactly like the language at a market top. I don't know one way or the other myself on that, but I doubt it. And this is the language of psychology, that when we are at extremes of events, whether that be markets or weather or anything else, there's a tendency for us to want to assume it's the new normal, and very rarely is it. Illiquidity, only 3 ways to lose money. One of them is not having enough cash to pay for life and other stuff. And the fruitfulness of trying to time the market. We make no attempt to time the market. We make every effort to assess where the market's at, so we can potentially delay or bring forward withdrawals or investments, but we make no attempt to jump in and out of the market based on what's happening in the media and the news. One of the other ways people mess it up is under diversification. The biggest worry for me this year is people that own too many banks. That's none of our clients. Owning a market proportion of the banks, absolutely fine, but I worry about retirees off the back of 30 years of bank prices going up. Some we see might have 50 to 70% of their portfolios in banks, and I think that's very unbalanced at the moment. And ultimately relying on past performance as a guide. But let me get into some specifics. So here's a headline, and sorry about the quality here, but I tore it out of the Australian Financial Review, and from a couple of days ago. China's growth slows to 30-year low. Now that sounds bad. Now keep in mind the way newspaper articles are written. A journalist writes them, and often there's some good stuff in there, but then a copywriter comes up with the most sensational headline that they can do so that people read it. And for the people that skim, they just take that all in. So slowest growth rate in 30 years is that bad. As they do point out in the article, it's still twice as much as the US is growing. And my important point is it's off a much higher base. So let me jump from trading economics, some actual figures. So the GDP of China is now nearly $14 billion. So when 14 billion grows by 6%, or let's go back 1 year. If you're looking from the right-hand side here, and you go back to last year, that's a lot of growth, from 12 billion up to 14 billion, even though it's only 6%. If you go back 20 years to 2000, that whole Chinese economy is less than the Chinese economy grew by last year. So in 1 year, China only growing at 6% has grown by more than its whole economy is worth 20 years ago. Now these aren't the stories you're seeing. So China's growth is solid. We'd sort of love to have that in the West. We're not going to have it, and if we had it, we'd be trying to put the brakes on to slow the world down. So China has now got an economy that is China's economy is 22% of the world economy. So it makes a difference. It's continuing to grow well. And considering it's up in the top, I think it's the second largest economy if you don't count Europe as an economy. It's the second largest economy in the world. If any of those other large economies had growth rates of 6%, they would be doing heel clicks. So like the media's spin is to scare us on that. Which will jump us straight into the other issue I'm going to talk about today, is should these new highs scare us? As we speak, the market's over, the ASX 200 is over 7,000, and all the news is around record highs. So let me take you through what happens in record highs. So here's a chart. So this is right in line with learning from history. This goes back to 1900. So it's the Australian share market, it's the All Ordinaries Accumulation Index. It only goes to 2010, but I'll show you what's happened since, because I haven't been able to find an update on this. But let's have a look. And the intent of this chart was to show sort of how big the major falls were and how long they take to recover. So you'll see falls of up to 50%, 65% briefly in the 70s. So big falls, and certainly things you should be scared of. Our whole framework is trying to know when we're in one of those. When are we in a position we're in one of those, and when aren't we? Because if we get that reasonably right, we're absolutely fine. And by the way, the growth rate since 1900 is 11%. So even if you did nothing else but ride through all of that, you do very well. So that's the long-term total return. in that top bit, but that's real return after inflation. So once again, inflation plus 6 to 7 is around about right for shares. But if we look at these red horizontal lines, you'll see that every time there's a major downturn, so think fear after the FOMO, well, firstly, again, a reminder, the bust always happens after the boom, never the other way around. Every single one of these downturns was after a boom, every single one, no exceptions. Now, in every single time, we always eventually hit a new high. Now, in all of those times, the media would be saying market hits record high, which it absolutely is. But if you look at 1920, hits a new high, starts one of the best 10-year runs of all year time. So it continues to make new highs for the next 10 years until the Depression. We have another downturn, and then by 1934, 33, we hit a new high again. Should we be scared? No. The market then goes into another magnificent run. Till about the 30s, then we have a downturn that lasts 7 years. It took 7 years to reach its high in about 1945, and then that was another great time to invest. Fast forward, another downturn in the 50s. When the market hits the high again, it starts another great run. When we hit the high again in 1985, another great run through to 87. When we hit the high again in the 90s, the start of a spectacular run through to 2010. And if we fast forward, we're just hitting the high again. And once again, that will be the start of the next bull market. It's the start of where we're back to equilibrium. So we're in the middle of that psychological pendulum. It doesn't feel like it because it feels high. And heights are a bit like if you're standing on the top of the mountain. So if you're at the top of this chart and you're looking down, we feel like it's really high. But if we're standing at the top of the mountain, at the bottom of the mountain, thinking about the future, which looks exactly like the past, then we look really low. So my message to you would be, this is certainly not the time to be scared or to be pulling money out of the market or even to be overly cautious just on the fact that markets are at new highs. In fact, if I look at that 100 years of history, I'd actually get excited that this is the start of another bull market. Now, we look at lots of other things, that's only one, but there's certainly no time in history where when we've hit the new high for the first time, that's been the start of a major downturn. That just hasn't happened, ever. So it's highly unlikely this is the start of another GFC type crash. I do think this year it's highly probable at some stage, and it could be later in the year, it could be we'll have a 5 to 10% correction, which would be healthy because it just keeps the market in the wall of worry, which is where we're less likely to make mistakes. But I don't think, based on history, a 20% downturn it would be unprecedented because it wouldn't have ever happened before from the type of conditions we're in. So let's go through the various markets. Aussie shares had a great year, up 23%, but keep in mind last year they were zero, average it out, roughly 11%. And once again, if you look at the 5-year average, we're at about 9%. 10 years, we're only 7.61%. Add some franking credits for us Aussies who get the benefit of that, and it pushes up to about 8.5%. Absolutely good return, but not spectacular, and certainly not something to be worried about. And you'll see the bottom chart here in the green shows once again that we're hitting that high. We bounced off it a couple of months ago. We've now broken through it, and hopefully it keeps going. It'll often bounce around there for a while just because of all the psychological worry when we hit a new high, but ultimately it's hit that because there's reasonable growth. We've got profit season coming up. That'll be more important than the fact that we're at a high, and hopefully it's the start of another era. US shares, 31% for the last year. That's in Aussie dollar terms. The top chart there shows the 5-year return, and you'll see that from that downturn. So a year ago, the market was at 2,400, but we're at the bottom in the US of a 20% dip. So the 31% was after 20% drop and a negative year last year. So once again, averaged out the last 3 years, 15. So the US has had solid returns, but still not crazy returns. And keep in mind, in the FOMO part of a boom, the market will have doubled in the previous 2 to 5 years. It's been 6 to 7 years since the US market doubled, so healthy, but not not in crazy territory. The other thing I'll point out about booms is in those crazy booms where we get corrections, the economy is also growing really strong, and the Federal Reserves and reserve banks are trying to slow it down by putting up interest rates. At the moment, we have the complete opposite. Economies are reasonably weak, and they're trying to fire up the economies by dropping interest rates and printing money. So we've got the complete opposite, which makes it completely unlikely that we're in another FOMO type condition. We've also got indicators like the credit cycle and margin lending. So during those FOMO booms, people are margin lending like crazy to get into the share market because it just keeps going up and up. There's almost no margin lending around at the moment. And also at the top of those booms, banks are throwing money at anyone and everyone. And we had low doc loans, we had liar loans. And this is throughout all those cycles, way back to 1929. And at the moment, we've got relatively subdued credit growth with banks still fairly cautious. So all of those things are no sign of a top that has a major crash as likely. We're still in the wall of worry, which means we're still likely to have the smaller downturns. US small caps, they had a bit of their downturn back a couple of years ago, which helped to make the market healthier. We were out of that market for a little while because 5-year returns and 10-year returns had jumped above 20%, which is a trigger for us to say we might want to be careful here. But with the correction they had back in 17, 18, they're back in normal. Once again, here, a good year last year, 22%. But if you average that at over 2 years, it's about 10, which is about normal. In 5 years, we're at 12.85, which is healthy, but not over the top. So we have that as fair. By the way, I didn't say it, but you might have seen it. The Aussie market and the US market we have as fair to expensive, and the same for global leaders, which is roughly around half US. So this global leaders exchange traded fund, or ETF, that we hold in the active portfolio, it's one of my favourites. It's just the 100 largest companies in the world. So it includes the heavyweights of Google and Facebook and all of those, as well as some of the more traditional big companies. And it's had extremely solid growth, 24% for the year, 5-year average 13, 10-year average 11. Once again, solid but not crazy. When we're seeing numbers over 5 or 10 years, it's starting to boost up from 15 to 20 and above, that's the time that we start to get a bit nervous, right when everyone else is getting excited and borrowing too much, etc. The bottom chart just shows what a great run it's been since the bottom of the GFC, which was sort of 07, 08. Now keep in mind, this is partly boosted by the Aussie dollar falling over some of that period, and that gives us an extra boost to returns in that fund. We have that as fair to expensive, but still an important part of portfolios. Emerging markets was the area that copped the brunt of the trade war. So it has lower returns over the last 5 years than others. We've seen a spike in the last little while as the trade war has looked like it's resolved. And I should point out, trade war resolved, it's partially a convenient resolution while Trump gets on to fight the election. I don't know if that means China wants Trump to win the election, but it would appear that maybe they do. Some of the commentary reads that as much as that might seem crazy, you've got a communist country supporting a far-right leader. They know what he is. They know what to expect. And on the other side, they don't know what to expect. We'll see what happens, and I'm sure they're going to meddle again, one way or the other. And in the long run, it probably won't matter much at all. But back to emerging markets, a good year, not as good as the other areas. If you remember, the other share markets around the world were up by over 20%. Emerging markets just up 13%. And if you look at the bottom chart here, you can see I've put here IOO against IM. So the one we were just looking at, which was the top 100 companies in the world, which is the dark black line with the grey shading, versus emerging markets. And you can see they were in sync until the start of the trade war, when it started to go the other way. And it's pretty much been flat since the start of the trade war. I expect that to catch up over the next few years if the trade war is genuinely solved, or as the market starts to think it doesn't matter as much. And that's purely because the trade war affects China and the emerging markets more than the developed world. So we still think emerging markets are cheap, an important part of the portfolios. Gold's another fascinating story. It had a massive year last year, although it's only showing 27%. Back in September, it was showing about 30%. And that's purely been the reaction to other tensions in the world, the trade war, then the US-Iran tension. It backed off a bit as the trade war was being resolved, but then spiked again with the US-Iran trade tension. We like having a little bit of gold in the portfolio just so there's when there's bad news, there's good news. But if you look at gold's 5-year chart, which is the one down the bottom, it really did nothing for 4 years, and then we've had this growth, and that's it starts to change the statistics, because that 1 year 27% year return, even if there's been almost no return before, all of a sudden, the 5-year return for gold is now 10%. Now the fact is 90% of that return came in the last year. So for the 4 years previous, it was only a couple of percent per year. This is why we've got to be so careful about statistics and who's presenting them to you and why they're presenting them to you. But gold, just right for us in the portfolio, regardless of what happens to it, particularly in this world of Twitter and everything else, where one tweet can change things pretty quickly for the short term, even though it will revert back. And gold just in the portfolio, we like. The performance of the care portfolios, and up the top once again are the core portfolios, and then down the bottom are the portfolios that include the active and the enhanced sections of the portfolio. It doesn't include the reserves, so the reserves would bring that back a bit. So they're all, when we look at the 1 year performance, 9% for conservative, 12% for moderate, nearly 16% for balanced, and 19% for growth. So spectacular returns, but once again, average it out over 2 years and it's about normal. In fact, when you look at the 3 years, that's about bang on what I would be predicting, slightly above actually in a 1% inflation, but 5, 6, 7, 9, 10 is pretty normal, and actually the 5-year return is bang on what we plan for in your portfolios, and slightly over if you allow for the inflation, but very normal in terms of those returns. And the care portfolios are performing in the upper quartile of their peers, and in some timeframes in the top decile, which is comforting and reassuring, considering we're very boring the way we do it, but boring wins in the long run, and we know that. Boring with very careful strategic adjustments from time to time. We've found over time that the boring proven stuff works remarkably well, and all the other stuff doesn't work so well, although it goes through phases of working where it looks like it's the new normal and is working. So let's have a quick look at property. And across the country, Sydney and Melbourne in particular have recovered. So you'll see the Sydney and Melbourne are now back in the green, in this case, up 5% year on year. Perth and Darwin are the struggling markets. Darwin in particular, Perth's a market that's actually bottomed, but it's got contradictory data in different suburbs. Some of the leading suburbs are starting to show signs that the bottom of the cycle is reached there, but Melbourne and Sydney back. I just sort of throw in this chart from Trading Economics, which shows the quarterly growth of property nationally. Now, you can't buy a national property, but it's handy to look at this just to see where the overall trend is. It's obviously partly dominated by Melbourne and Sydney, but we see that downturn that we see there, the negative bars there, which was the downturn in Melbourne and Sydney, not too drastic, and now clearly recovered within the last quarter. Property prices across Australia up 2.4%. If we go back 20 years, we see the cycle, periods of growth followed by some downturns, pretty normal. Once again, that psychological pendulum. But property in the long run is driven by economic growth and population growth. And while Australia continues to have both, we will see climbing property. If our population growth stopped, we may see a plateau of property increase, or certainly a limiting of it, but there looks to be no plans to stop that. Let's have a look at what Heron Todd say about the property clock. A few changes there. The changes are in orange, so they've sort of got Adelaide to the bottom of the market. Some of these things have moved pretty quickly. I like the way Heron Todd does this. I don't always agree with it, and I'll see different people do different things, but it's always a good reminder. What I like about it is a reminder that markets go through cycles. Those cycles don't always take 10 years or 15 years. Sometimes you can have a quick cycle. The downturn of Melbourne and Sydney was extremely quick, and it's interesting. Heron Todd White now have them at 7 o'clock, which in my language, is a good time to buy. You've got to be very careful in those markets, and you want to be buying where there's supply demand imbalances and there's not too much supply, and where there's population growth. So anyone thinking about property, talk to us. We certainly have firm views about where are the better places to buy around the country. The National Property Clock for units, very similar, no real changes there, and nothing too different than the housing one. To wrap up and put it all in perspective, and the reason we do this is because with good perspective, our view rarely changes. One of the reasons we have way above average returns is because we can put things into perspective. We're not jumping at shadows all the time, or jumping at news. So current conditions, it's steady as she goes. It's stick with your plans. If you're topping up or pulling money out, it's a reasonable time. It's probably a better time to be tapping money out if you need a car, or if you're giving money to the kids, or you need to pull money out in the next few years. It's not a bad time to do that at the moment. For people that are got a lot of money putting in at the moment, we're spreading it over 12 months. That's not because we think it's a bad time, but just to spread the risk. So there may always be better times to buy. So we never know. That's why we'll often average, and why we love dollar cost averaging. And if the market gets a little bit more expensive, it's always a good time to rebalance, and we'll continue to average in new money or defer some of it. We never want to wait completely. One of the saddest things I see when we have a full cycle is people are waiting. Then eventually the markets are running so hard they can't help themselves. They go in, and often that's right before the crash. So much better to be averaging in steadily. And if you average in steadily, you're never going to get the worst time. And I'll just reiterate, we are nowhere near one of the times where the market is likely or potential to drop by more than 20%. Where we hit a record high off the back of a major downturn, it's normally a brilliant time to be investing. So good time to rebalance as always, top up the reserves, and we'll continue to review when we sit down. So I just want to reinforce the process once again, and the process is designed so you can have an exciting life and boring money, and not the other way around. Goals first, based on the stuff that's important and the people that are important to you. Portfolios designed to meet those goals. We do take a long-term view, but we're very mindful of the short-term in decision-making and on the behavioural impact. Then once we've listened to those 4 pillars, learn from history, understand the psychological things, the mistakes that can be made, we can then get down to designing high-quality portfolios where front and centre is diversification, asset allocation and liquidity, and low-cost access to most of those growth markets, so that we can protect, and then we want to protect against that short-term volatility. And we do that with dollar cost averaging for those of you entering the market and growing your wealth, and reserves for those of you that are drawing down your wealth during retirement. Rebalancing regularly changes that, and that's it for today. To wrap up On Track, I thank you very much for listening. Look forward to catching you, and look forward to seeing what the year brings. It's, as always, it's going to be an interesting year. Till I see you next time, Rob McGregor signing off.